Howdy, partners. Here on the Compounding Dividends channel and in our newsletter with 150,000 subscribers, we focus on dividend growth investing. And that's because it's a really good way to build wealth over time. Companies that have consistently grown their dividends have outperformed, and companies that don't pay them, keep them flat, or cut their dividends have way underperformed. So today, we're going to make sure that you avoid those companies that destroy value. I'm going to go through 5 common dividend investing mistakes, and I'm going to show you how to avoid them. And if you want a checklist of what I'm about to talk about, there is a link in the description. Go ahead and click it and download your checklist. Mistake number 1, chasing high yield. If a yield looks too good to be true, it probably is. So high yield often means poor fundamentals or a high risk company. Not always though. So how can you tell the difference? Well, if I see a really tempting yield, the first thing I do is look at the business fundamentals. And one of the first places I go is the revenue and the earnings. And what I want to see here is that this company is growing both. Dividends are going to come from the earnings of the company. And if we have a company that's either flat or declining in their revenue and their earnings, that's not a good sign for the dividend long term. The second place I'm going to look is the payout ratio. And what that measures is how much of the earnings the company is paying out as a dividend. If this gets too high, then that company is probably not reinvesting in growth, and that dividend is probably at risk for a cut. The third place I look is the balance sheet. Some companies historically have used debt to finance their dividends and keep them growing, and that's a red flag for sure. GM was famous for this around the 2008 time period, so this is something that I look for. Now, let's look at an example. Kraft Heinz had a 6% dividend yield back in 2018, but in 2019, that dividend got cut. But if we look at free cash flow versus dividends, we can see that for years before this, Kraft Heinz was paying out more in dividends than it was earning. If you were paying attention to this, you could have seen that dividend cut coming and either avoided investing in Kraft Heinz, or if you already held the stock, this gave you time to sell it before the dividend cut happened. Mistake number 2, not diversifying. So a pretty classic beginner's mistake is that you find something attractive and you get really excited and you put a big part of your portfolio into it. This can mean that you're really concentrated in a few companies or even a few sectors. And this can be a big risk because if something happens to one of those companies or one of those sectors, then a big portion of your portfolio is at risk. And the way we avoid this is pretty simple. We try and spread our money amongst several different companies and ideally several different sectors. This really reduces your risk, and let me show you why. So this chart shows what's called systemic versus idiosyncratic risk. Now, systemic risk is the risk of big giant things happening. Things like, recessions, runaway inflation, something like the COVID pandemic. These are things that affect every single company, entire economies, entire nations, and there's really not a way to diversify away from this. The other type of risk is what's called idiosyncratic risk, and this can also be thought of as company or industry-specific risk. So this is things like bad management, product failures, maybe an industry is cyclical, something like energy. If you have a bunch of energy companies, they're probably all going to go down at the same time. And the beauty of diversification is it only takes 20 or 30 positions to really diversify away from that idiosyncratic risk. The systemic or the market risk is always kind of going to be there. That's just something you accept when you invest in equities. So remember, don't put your entire portfolio on the shoulders of one company or one sector. Mistake number 3 is ignoring the payout ratio. Now, we already talked about the payout ratio a little bit, but I want to dive in a little bit more because this is important. We can't see the future, but when it comes to dividend sustainability, the payout ratio might be the closest thing we have to a crystal ball. Like I said, this is the portion of earnings that's paid out as a dividend. And when it gets too high, it is a giant red flag that this dividend might not be sustainable, or at least that you might not see a lot of growth. So the way to avoid this is to set a limit for yourself. And for me, for most companies, I like this to be under 60%. Now, if I'm investing in something that's slow growing and pays a high dividend yield, something like tobacco companies is a classic example, up to 80% is acceptable here. So you do have to vary this based on sector and the type of investment. One other thing worth mentioning is that the typical calculation you see for this usually isn't applicable to things like REITs or master limited partnerships. They operate on kind of different metrics than earnings. For example, a REIT, you're going to look at FFO, not earnings per share, to calculate your payout ratio. But remember, the biggest thing is that a healthy payout ratio tells you that the company has room to grow the dividend, room to reinvest in the business, and they have some wiggle room if things don't go well. Mistake number 4 is focusing on the yield and ignoring the growth. So in dividend investing, a high yield up front is tempting. And we talked about high yield traps in mistake number 1, but this is more about the long run. So let's compare a couple different investments. So first, we're going to use the dividend aristocrats. These are companies that have grown their dividends for at least 25 years in a row. And we'll compare that to the Dow Jones Select Dividend Index. These are the highest yielding companies in the Dow Jones Index. So if we look at this chart, we can see that it does not take long for those dividend growers to outpace those high yielders, about 8 years in this case. So the lesson here is that companies that sustainably raise their dividends over time will eventually give you more income and a higher total return than most high yield companies. And it doesn't take as long as you might think. So a few things to look for. A 5-year dividend growth rate at least above inflation. I would say put 5% as your bottom. You want to see consistent earnings growth. Remember, earnings from the business are what the dividends are going to come from. You want to see a low payout ratio, as we already talked about, so that there's room for that dividend to grow. And you want to see strong cash generation from that business. You want a business that can take what it takes in and actually transform it into cash. So don't just chase that high starting yield. Chase after those companies that can consistently pay you more and more every single year in dividends. In the long run, you'll do much better. Our 5th and final mistake, it's buying income and not businesses. Dividend investing isn't just about collecting checks. It's about investing in great businesses. So if you buy businesses that consistently grow their earnings, then your dividend income is going to follow. So you need to understand the business that you're investing in. And the best way to do that, well, 1, you need to read a few years of annual reports. I'd suggest at least 3. And you need to understand the management. Read interviews with the CEO or the CFO. If they write shareholder letters, make sure that you read them. And you need to understand the business's moat. These are the competitive advantages that protect it from competition. If you want long-term growth, then you need a moat. And finally, you need to understand the industry that business operates in. It's really hard to be a great business in a bad industry. And you need to think about what can go wrong, not just what can go right. You really need to understand the risks of the businesses that you're choosing to invest in. And one of the best ways that I know of to pick great businesses is to use Warren Buffett's 10-year test. Buffett says that if you wouldn't be comfortable owning a business for 10 years, then you shouldn't own it for 10 minutes. And the way he suggests to think about that is to pretend that after you buy your business, that the stock market's going to close for 10 years. You're not going to be able to sell it. If that makes you nervous, you probably either need to understand the business more or find a different investment. All right, so let's quickly go over what we learned today. 1, high yield can sometimes signal high risk. Number 2, diversification protects your portfolio from company and sector specific risk. Number 3, the payout ratio is a really good window into the sustainability of the dividend. Number 4 is that dividend growth is just as, if not more important than the starting yield, especially the longer your time horizon gets. And number 5 is that you need to focus on buying businesses, not just income streams. If you found this video helpful, don't forget to download your checklist in the description, hit the like button, subscribe to the channel, and leave me a comment. Have you made any of these mistakes? Which ones cost you the most money? I'm curious to know. Thanks for watching. See you next time.